and welcome to the show. It's great to have you with us. The U.S. Federal Reserve is cutting rates by 25 basis points, and some have touted this rate decision as one of the most important in years. Let's get right to it. James Orlando, senior economist at TD Bank Group, joins us now to take us through this and a few other things he's been taking a look at. It's nice to see you.
Nice to see you.
Let's start with the declaration. This is the most important Fed decision in 10 years. True or false?
Yeah, I think it's very true. This is the first time the Federal Reserve's cut rates in over a decade. The last time they did it was in the financial crisis. You know, when you think about what the Fed's doing right now, they're really signaling that they're there to help out the overall economy. And I think people are going to be talking about this insurance cut for many years to come. Hopefully, it'll be along the lines of when the Federal Reserve did insurance cuts in 1995 and 1998 to expand the economic expansion during that time. It's
interesting because you talk about the fact it's an insurance cut because it certainly isn't needed if you look at the current data in terms of employment or GDP right now. So just maybe give us a little sense of what that insurance is for.
Sure, you said it perfectly. Consumers are doing very well. The labor market's strong, and those numbers are looking great. It's what's happening with respect to the international markets. The Federal Reserve is acknowledging that that's starting to impact manufacturing in the United States. That impacts business confidence. And as we know from looking at business confidence over history, the first thing businesses do is they cut investment. And if they keep being negative, and if the world doesn't change and things don't improve, then what they cut next is labor. And that's when you really start worrying about the economic expansion.
Yeah. Do you expect that the Bank of Canada is going to take its cue from the Fed on this or not?
So I don't think the Bank of Canada needs to cut rates right now. The Canadian economy is actually bouncing back pretty good from some weakness over the winter. The other factor is that when the Federal Reserve cuts interest rates, that reduces interest rates in the United States, but it also reduces interest rates in Canada. So Canadian yields are down as well based on this information. And that plays through to a whole suite of different credit variables. So mortgage rates in Canada, people have noticed they're coming down. That supports housing. So the Bank of Canada doesn't need to do anything, and they're already seeing the benefits of the fact that the Federal Reserve is cutting rates.
And just to be clear with people, if they don't follow the mortgage market closely, this is the fixed mortgages that key off bonds, right?
Yeah, exactly. So usually when banks price mortgages, they price them off the Canada yield curve. So when the Canada yields come down with the U.S. yields, then mortgage rates come down with that.
Let me ask you about a report that you put out recently. You were taking a look at long-term financial asset returns, taking a look at what's happened in the past little while. And we've got a board here we can show everybody here in terms of, you took a look at what happened from 2000 to 2009, 2010 to 2018, and then a range of what you're expecting for looking ahead. Why, first of all, did you do this? What was the reasoning you were looking at this?
Yeah, so a lot of people talk about global growth slowdown. We hear about that all the time. But the connection isn't always made between global growth and how that's going to impact Canadian investors going forward. So whether you're planning for retirement, planning to buy a house, all of that matters when you're trying to save money. And so what we wanted to do in the spirit of financial literacy, we wanted to make sure that people were aware of what kind of returns they can expect in the current global growth regime that we're looking at right now.
I'm going to jump around here a bit, but I think the first thing when someone looks at that chart, I'm going to ask them to bring it up again, is it's lower for the most part. I mean, the returns that you're expecting for 2028, so it's a long time from now, I couldn't say it properly. They're materially lower than what we saw in 2010, 2018.
That's exactly right. So given the fact that we had an expansion during that time period, we had a lot of positive movements in equities specifically. So we had a rebound from the financial crisis, and that helped a lot. We had strong economic growth during that time period. As I mentioned, growth is looking like it's going to be a little weaker. Inflation's low. Bond yields are low. Equity evaluations are quite high right now. So what are the next 10 years going to look like? Well, you're probably not going to be able to get the same returns as you did during that expansion from the financial crisis.
Let's get into each category. Long-term bond yields, you mentioned, they keep heading lower right now as we're seeing. So is this just bad news for bond investors?
Well, if you think about what's happened in the fixed income and the bond market, you've had about a four-decade bull run for bonds. What that means is that bond yields have been declining for about 40 years now. In 1981, you could lend the Canadian government money for 10 years, and they would have given you a 17% return every year. That same Canada 10-year bond yield right now is about 1.5%. So you're not going to get the same return going forwards. And so if you look at 1.5%, that's the return you're going to get. So when we think about how yields have gone from 17 to 1.5% right now, we're getting pretty close to that lower bound for where yields can go to. So how much more return can you possibly get? And so that's one thing, and it's a big part of people's portfolios too. So we want to make sure that people know that that big part of your portfolio might not return. It'll probably just keep up with inflation over the next little while.
I'm still caught on 17. I'm still on the 17% getting back in 1980. So It's a sobering number. What is the implication of that too, I guess, and that's part of the reason you did this, was to say, hey, you know what, you're not going to get the returns here, you might have to look elsewhere, but that means going further along the risk spectrum.
That's exactly it. So people are very worried about the fact that when you have safe assets that are not going to give you much return, people go into more risky securities. And so people move into things like corporate bonds that might be lower in quality is what's happening right now, or move into equities or move abroad for equities. So when you have that, there is risk that gets built up in the financial system. And a lot of people have commented that there's risk to that happening. So we might actually be in for something worse if that continues.
What we saw, of course, with equities is, and again from the table that you brought, is that the returns for U.S. equities have really outperformed Canadian equities.
Yeah. Yeah, they've dominated based on the fact, two major factors. One is that you had a strong market power with respect to some of the firms in the S&P 500. The firms that have done well are ones that have been able to, you think technology, you think of consumer discretionary, global corporations that have really invented new technologies, taken advantage of some of the new trends that are going on. And so they've been able to capture profits in that way. And the other way they've done it is going abroad. So by making sure that they've invested abroad, making sure that they're taking advantage of high growth emerging markets, they've been able to capture strong returns from there. And so the companies of the S&P 500 have done the best job of that relative to what's happened in other developed market stock index.
What are they going to have to do to keep a return up? I mean, because you said you've expanded, you've kind of done all those kinds of things, but what more can be done? Well,
it's hard. One of the things that might have contributed to is tax reform in the United States. Are we going to get tax reform again? Well, probably not, right? When we look at how returns are going forward, corporations are already taking a pretty big piece of the economic pie right now. We're looking at the S&P 500 had a return for their earnings per share of about 11% per year over the current expansion. If nominal growth in Canada and the United States is going to be about 4%, it's going to be hard for them to outperform the overall economy that strongly. And so we think that our return expectations for the S&P 500, for the TSX, for those corporations, we think that it's going to have to be a little bit lower over the next 10 years.
I've only got about 30 seconds. This is an unfair question to ask with 30 seconds. But so what do you think, is there anything that can improve the economic outlook, of which then, of course, companies key on that with their growth as well?
Yes. So the biggest thing that we can have that can improve growth outlook, or the growth outlook, is that we have improvement in training and attracting high-skilled workers. And you do that through immigration practices, and Canada's done a great job of that, and also through education. And so we've done a great job of that in Canada. And the other way is that we incentivize corporations to invest in new productivity-enhancing technologies. And it's not just equipment, it's your research and development. And if you're able to do all of these things, then what that does is improves the growth rate of your country, it improves your competitiveness, and it also improves asset returns.
Good things to hope for, and we'll have to see if it actually comes to fruition. James, always a pleasure.
Thank you.